Every insurance agent says the same thing. Buy 10 times your salary. Do that and you're covered. But one number wastes a fortune for one family and leaves another $500,000 short. The real formula isn't a multiple of your paycheck. It's 4 letters, and almost nobody uses it. This 10 times salary rule survives because it's fast. One sentence. Sign here. Next client. Agents, banks, and finance blogs all repeat it. But convenience isn't accuracy. A rule built for speed was never built for your specific family. Strip away the sales pitch, and life insurance has one job. Replace what disappears if you die, the income your family depends on, debts still outstanding, future costs someone else would suddenly carry alone. It's not a multiple of your paycheck, it's a mirror of your actual financial life. Meet 2 people, same $70,000 salary. Person A is single, rents 0 debt. The 10x rule says buy $700,000, but if A died tomorrow, their family needs maybe $15,000 for final costs. That's $685,000 paying for nothing. Person B has the same salary, a stay-home spouse, 3 kids, and a $300,000 mortgage. Same rule, same $700,000, but B's family actually needs well over $1 million. One rule, 2 families, both failed in opposite directions. So what actually works? Planners call it DIME, 4 letters, 4 questions. D, debt, everything owed besides the mortgage. I, income, years of income your family needs replaced. M, mortgage, the remaining balance. E, education, the cost to raise your kids without you. Add those 4 and you get a real personal number, not a guess borrowed from a stranger's paycheck. Run the real numbers for one family. $20,000 in debt, $50,000 a year in income, replaced for 10 years, $500,000, a $250,000 mortgage, $60,000 for 2 kids' education. Total $830,000. Not $700,000 from a salary multiple, $830,000 from their actual life. One step most people skip. Subtract what you already have, savings earmarked for the family, plus any free employer life insurance. Say this family has $80,000 already covered. $830,000 minus $80,000 leaves a net need of $750,000, the real amount of new coverage to buy. Here's the surprising part. A policy that large isn't expensive when you're young and healthy. Term life, coverage for a set number of years, no investment attached, gets dramatically cheaper the earlier you lock it in. A healthy 30-year-old and a healthy 50-year-old pay wildly different prices for identical coverage. For a healthy 35-year-old, $750,000 of 20-year term can run about $34 a month, less than a streaming bundle. Pennies a day for the exact number your family needs, calculated by dime instead of borrowed from someone else's paycheck. Recap. 10 times salary is a guess, and guesses are wasteful or dangerous. Dime replaces it. Add your debt, income replacement years, mortgage balance, and education costs. Subtract what you already have saved or covered. What's left is the real number to insure, and cheap term coverage, bought young, makes it affordable for almost anyone. Grab a pen and run your own dime number this week. 5 minutes that could change what your family is protected for. This is education, not financial advice. Talk to a licensed professional before buying. Subscribe for more money concepts, explained simply.